Hey everybody, what's up? We are back with another stock analysis, and today we are looking at Five Below. So if you don't know what Five Below is, it is a retail chain that is, I believe, primarily based in the United States. And as far as I know, they are most likely on the decline. I doubt we're going to be seeing anything too crazy from the financials today, but you never know, we might be surprised. So the video today will be an analysis of the company, focusing primarily on financials, and we will go into their recent earnings reports a little bit as well. So if you're interested, make sure to subscribe, and let's get into Five Below. So, looking into the company today, they primarily focus on discount retail, or as they call it, specialty value retail. That's basically just discounted stuff. The last time I went there, they have a lot of electronics, things like that. I honestly haven't been there in probably 5 years or more. Looking into some of their metrics, they are actually showing positive same store sales growth every single quarter, or at least an estimate every single quarter for the remainder of 2025, which is pretty good. Net sales per wow, that's a big one. Net sales per square foot in their retail locations are expected to increase over the year, which is also kind of surprising. Selling space, total square feet is expected to increase. Number of stores is expected to increase by a lot over the next year as well, which is, again, very surprising. And they're not expecting to close any stores and are only opening double-digit amounts of stores every single year, which honestly, I'm surprised by a lot. I really wouldn't think that they would be growing very much. At the very least, not growing this much with 200 stores essentially within the next year, or close to it at least. That's pretty crazy. So market cap is currently a little over 4 billion. They IPO'd in 2012. And let's see, target price is at $100, very small long-term growth rate. Right now we are at 76, so they are considerably under that target price, which could be a pretty positive thing. Looking into the growth summary, we're actually seeing a lot of positives here. Other than the 1 year where they're expecting some pain, we're seeing positive numbers across the board. What I will say is that they aren't the highest, but again, with this kind of company in retail, traditional brick and mortar retail locations, having any positive numbers is shocking. So that is really good. So anyway, let's get into their earnings report now and see what they've been doing recently. So we do have a metrics recap and a street takeaways. So we should get a decent amount of stuff from here. So operating metrics, it looks like they beat slightly on their comps percentage. Gross margin also beat very slightly. SG&A was considerably below estimates, which is a really good thing, cutting costs very effectively. Operating margin also beat. And one thing I will say that's a little concerning is their inventories grew faster than their sales did, which I've brought this up in the past a couple times. When your inventories are growing faster than your sales are, that could be concerning. However, it could also be a good sign for the next year where they have a lot more inventory to sell, so they'll be able to have a lot more sales. That is a possibility, but either way, they are seeing sales growth as a traditional retailer, which in the current state of the world is really surprising. I forget what company we just went over a couple, probably less than 2 weeks ago, where they were a retailer. I can't think of what it was, but they were declining a lot, and it just did not look good. For the life of me, I can't remember, but I just did a retailer the other day, and it was not looking good at all. Can I find it in the next 5 seconds? Possibly. I'm not seeing it. I swear I did one though. But anyway, moving. Victoria's Secret, I think, wasn't doing super good. They've been on a decline for a while. Anyway, moving on here. Let's take a look at their chart. This is still Kodak. Let's go over to Five Below. So they have also been very similar to Victoria's Secret, actually been declining for a good long while now. Have not seen a high since 2021. They are, however, it looks like they are hitting a very strong support area possibly right now. And yeah, I mean, I would say it's a pretty good support line for them. So if they can hold this line, which it looks like they kind of are, however, they did just hit a new recent low this morning, with the most recent low being right around $65 a share. Um, If they can lock down the support here, there's a decent chance of it going a lot higher. And honestly, based on this report, it most likely will go a lot higher. Let's look at the daily chart. Since the report, they are up. They were down a little bit, but that's probably just because of the overall market, if I had to guess. But overall, I think that report is really good just based on these metrics at the very least. Let's take a look at the street takeaways now, and we'll hopefully get a better idea of how things are going. So they were up 5% almost on the report. Revenue was above the upper end of guidance, which is awesome. Comps were 30 basis points above. Margins were above. Again, SG&A notably better. Inventories are up. Everything we already went over. So analysts were mixed with strong quarter four results and a positive quarter one guide, offset by, again, tariff impacts, which we're seeing that with every single company nowadays. Strategic focus on core customers and value pricing is seen as positive. Execution and mitigation of tariff pressures were seen as crucial to achieve their growth targets. Most were upbeat on near-term trends due to easier comps, and I don't know what improving shrink means, but I'm guessing it's good. Um, Many remain concerned about margin pressures and the need for significant comp growth to drive a sustainable recovery. So one thing I will say is that they saw really good margin growth, which partially addresses the concerns there. SG&A being that much better, I think it was like 3% better, is huge, especially for a company that probably relies on a decent amount of marketing. And I mean, revenue was at the upper end of their guidance. That's really solid. If you want to read through what all of the analysts here are saying, you can pause now and do so. I'm not going to read through everything. One thing I will say, though, is that we're seeing a lot of price targets being lowered. Um, Lowered here. Target remains at 85, maintains a perform, and target lowered to 86, which is still above where we are now, to be fair, but either way, that is a little bit concerning that they're lowering their targets based off of the report there. So, anyway, let's go into the straight up financials now and see how we've been doing. So, this company, wow, has actually been seeing really strong growth over the past few years. Apparently, their fiscal year 2025 is already done, which is wild considering it's April. But either way, looks pretty good. Growth is very consistent every single year, which is insane. Even 2021, they saw solid growth. The year after, they saw one of the largest increases that I can see here on record. In the same time, looks like SG&A is again increasing a lot as well, but still the sales are crazy. Net income has not seen a high though since 2020, or I should say since 2022 they have not seen a high on their net income, which isn't great. Decreased profitability. That does make sense with their margins now. They haven't seen increases in those solid margins in a while, at least on a year-to-year basis, which could be concerning. Operating income as well, same thing, has not seen a high in 4 years. So overall, pretty concerning there. Their sales are growing a ton, but in doing that, their margins are failing and it may be fairly negative. I'd imagine their primary focus now is on those margins. So hopefully we can see some improvement. Moving on from that, total shares have been decreasing for 4 years straight now, which is pretty good. Looks like they repurchased 1 million shares over the past 4 years. So can't really complain about that. Let's move on now to the balance sheet and see how we're doing. So looking in here, we have about $500 million in total cash with just about $2 billion total in total debt. Most of that being long term. I wouldn't say that's too bad, just considering they have more than enough cash to cover their short term debt, which I usually view as being fairly positive. Can't really complain about that. Let's see. Equity is positive. So their debt to equity ratio is still under 100%, which isn't too bad at all. Can't complain about that, honestly. Um, so overall, I would say they're in a pretty good position for being, again, traditional brick and mortar retail. You don't really see those companies performing that well like we're seeing now, especially the ones that aren't super diversified like a company like Walmart and Costco are. So seeing this company perform this well is surprising, but it's a pretty good surprise. So that's all I've got. Let's get into the cash flows now. So operating cash flow looks pretty good. One thing I will say is that they are at the higher end of the cash flows they've been seeing. So their cash flows are improving while their profit isn't, which is still a pretty positive thing, um, at the very least. I would say it's pretty positive, at least. Investments activity is kind of mixed. They sort of change it up every few years, whether they're buying or selling off their investments. Can't really comment on that, to be honest. It's just kind of what they do. Again, we see they're repurchasing stock every year, which is awesome. That's great to see. No debt activity really going on at all, which is strange because they do have a ton of debt, but it doesn't show them as issuing or reducing any of it in the past few years. So that could just be not being included here in the statements, but it is on the balance sheet. So there is debt there. Um, Other than that, free cash flow looks pretty good. Let me just see. They're kind of at the higher end of what they see normally. Back in 2021 and 20 and actually last year, they saw a lot more than their current fiscal year, but still a fairly good number, despite having less profit than they used to. So either way, they are performing fairly well in terms of the cash flow. So last but not least, let's go over the ratios here and see what's going on. So we know their profitability has been decreasing. You could see that their gross margin was very consistently around 33% for many, many years. During COVID, it dropped, came back up, and since then it has been declining. SG&A looks like has been actually higher than normal, at least in their fiscal year 2025. So now it is being improved fairly significantly. But either way, they're basically at the exact same range that they've always been at, as we can see here. Operating margin has been declining for 4 straight years. Looks like same thing with net margins. So overall, pretty concerning there. Again, we've talked about the margins. It's definitely their biggest concern. And then debt to equity actually is a little bit over 100%, which would put it in the unhealthy range. The only comment I would have for this is that it has been declining, which is a good thing, for the past 5 years. So they have been working on reducing that, which is pretty good. Again, can't really complain about it when it's improving. So overall for the company, I would say it is mixed. They're showing really good revenue growth, but their margins are suffering. Debt situation could be a problem, but considering it's, again, brick and mortar retail store, I wouldn't really be that concerned with it because usually that's just how they operate. They always have a lot of debt. So saying that, that's all I got for Five Below today. If you enjoyed, make sure to subscribe, and I will see everybody in the next video.